Good morning, everybody. Welcome back to the Schwab YouTube coaching channel for the Monday edition of Trader Talk in today's market. I am your host, Kevin Horner, joining you from a sunny and beautiful Denver, Colorado. Today, I am running solo with all of you. Thanks for joining me today. I am joined by my friend and fellow coach, Brent Moores, there in the chat. We're going to get to a number of key details in the market as we kick things off for this first trading day in the month of June. We're starting a little bit in the red, it looks like, and I've got some reasoning behind that. We see a little spike in oil today, a spike in yields today, probably putting a little bit of pressure on the broader markets and indices, but we'll take a look at the charts and see what we can learn from those here shortly. As I mentioned, with being joined by Brent in the chat, make sure you're following us on X, Brent Moores, CS, Kevin Horner, CS, a good spot to find us when we're not hosting classes for you here on the channel. Make sure you're subscribed to the channel, of course. Let's get to those disclosures and we can move into the news of the day. So first of all, remember that everything we discuss for you today should be considered informational and educational only. We do not make recommendations nor any endorsements for a specific approach to trading here. What we do is offer insights and concepts, strategies traders who utilize technical analysis may choose to employ. The extent to which we discuss technical analysis, though, just remember this is merely one of your decision-making puzzle pieces, not the entirety of it. So make certain that you are evaluating the markets on a multitude of factors, making your trade decisions based on a multitude of concepts and ideas, not relying exclusively off technical analysis. Now, if you are new to our class here, we do a top-down review of the market. What that means is that we'll start with our broadest indices. We'll look at the S&P 500, the Russell 2000, the NASDAQ 100, semiconductors. I called out oil and yields. We'll look at both the 10-year yield today, crude oil as well, and try to get a picture on where we may have some interesting opportunities presented this week, perhaps. So with all of that in mind, let us start with a look at the S&P 500 here. So the SPX getting a little bit of a red candle to start the day. We're kind of flat, negative 0.12. Not a whole lot of good reason to be immediately concerned. Remember that the trend that is in play is more likely to continue than to break, just based on tendencies and the way that the market works, right? We talk about probabilities, never certainties. And one thing we know about trend analysis is that the trend is more likely to continue than to not continue. And so this is one of the reasons that you see traders so confidently stepping in to opportunities along, in this instance, perhaps the 20-day moving average, which in orange has continued to be quite an area for participation. And when I say participation, what I mean is that when we undergo those windows of consolidation like this, where you go sideways for a week or so, and it allows that 20-day moving average to catch up with the price action a little bit, those are the instances when traders start to deploy new dollars commonly, right? And it's common because they want to be a buyer near the trend line, the area of short-run support, because it helps them understand whether they're getting in at what could be considered to be a good price. Also, it gives them the confidence that if they stepped in along the 20-day and it did not maintain, well, then they would be looking to either eliminate that position, move out of a chunk of that position, reduce position size, those types of things as you break down are ways to work to maintain capital. Another reminder for you, as much as we love to trade, the important aspect of trading as much as anything else, yes, we're trying to make money, but it's important that we work to preserve capital as well, and that comes through in the form of risk management. So remember, the true risk of your portfolio, if you're trading it, is largely the amount of cash you're sitting on is your comfort zone, right? And if you deplete that cash down to an uncomfortable level, that means that your dollars are all in the market, all invested. So be aware of what your true risk is and what keeps you in those positions. Commonly, we find ourselves making decisions based on a lack of comfort or a fear factor. And more often than not, if you find yourself taking action at times when the market isn't dictating it, but you are feeling uncomfortable, it largely means that you're overinvested. And we need to figure out what that means to each of us individually. That'll give you a lot more comfort to trade the market if you can really understand where you fall on that risk parameter. So more of the same with the SPX, at least to start the week. The trend continues. Let's see how we're looking here in the NASDAQ, also kind of flat, more of the same. Let's not really belabor the point. Everything we said about SPX can be applied heavily to the NDX, right? 20-day moving average. Trend line continues to provide support. Are we a little extended? Sure. Could we get a consolidation window? Sure. Could we go sideways and allow that 20-day to catch up with a horizontal support? And I call it horizontal support because they were peaks, right? This was all-time high. All-time high. We waited here. We got up to that level and waited. And then the next day we broke through it and continued higher. So we had a great week last week. And it was, technical traders would tell you, it was because we moved to new highs and we had some momentum. Now that we've got that level achieved, maybe we extend that line out. Let's go out to, just this week, for example. This could become horizontal support for us. We could get a little confluence with the 20-day catching up to that level, and some traders might use this as a way of managing their risk. But basically, when we're looking at the trend of the SPX and looking at the trend of the NDX, there's really not a lot of discrepancies between these. They look very similar, don't they? Now, let's look at the Russell. It's going to be pretty clear discrepancy today. We're off 0.75% in the Russell today. And as I mentioned off the jump, likely due to the yields situation. So we did make a new high in the Russell last week, pulling back to an area there, our breakout spot, just like we talked about in the NDX. This could be support. The 20-day, as you can see, gang, we've been kind of not as consistent with the 20-day here. It's been one that's been violated a couple of times. Whoops, I didn't mean to duplicate. I wanted to remove that. There we go. So we've had a good move. And the 20-day, we'd like that to be supportive, but we were below it for a good period here. But, what often happens, as we say, as we will frequently mention here, is that when we get below the 20-day or the trend, the dynamic trend line, in this case the 20-day, we will frequently find support at a horizontal level. So if we did take out the 20 like we did last time, maybe it's not this level down here coincident with the 50-day. Maybe it's that last horizontal support right in here, right? Something like this. So if we broke the 20, this could be an area where we see bulls be willing to step in a little bit. So we'll eyeball that. That's just shy of 2,800 here. Okay, so now I'm seeing more, continuation of these moves, but ultimately the move in the 10-year yield, probably the biggest reason for pressure on the small caps at this point, everybody. So let me highlight this. Take a look at the Russell and then into the 10-year. The yield on the 10-year has dropped quite nicely, right? From 4.7 down to the lows we've hit last week, under 4.5, so 4.43 or so. This is the rally we're seeing today. Essentially, this looks like a bullish chart if we were talking about this from a standpoint of just evaluating the trend. So I'm going to zoom in into just what's gone on since March, just to give us a little bit of clarity here. And what you're going to see essentially is that we've gotten a pullback to an area of support, yes, below the 20-day, but we have set up in here, everybody, higher lows every step of the way, right? So higher low here, higher low here, higher low up here. And it looks like I'm getting a little bit of lag with my platform here, everybody, so I apologize for the delay. But ultimately, what we're seeing is a bullish chart as it relates to the yields, and that can be a bit of a a headwind for us with our small cap positions. So we need to keep a close eye on this. The level we have rallied back into right here is fairly significant. You know, we had 4-5 as an area of resistance, and now we have it as resistance once more. I'm going to extend this line out to make sure that I capture the price action of this week. So give me just a second here. I'm going to extend this out just a few weeks here on my calendar. There we go. So we'll go to this Friday. There we are. All right. And so with this 4-5 level becomes quite important for us, right? Because we've been dabbling with that ledge. We need that we get through it. We saw the rally. So maybe now that we're at it again, it can be resistance once more. And I should also point out, everybody, I mean, the instance above that level looks as though it could be a topping formation. Why do I say that? Well, because it created a huge gap and it kind of looks like an island up there, right? So if we get rejected here on the yield, that would be a wonderful development for small caps in the broader market, perhaps. So we wouldn't mind seeing yields pushed back from here, but this ledge to which we have rallied, 45 on this, 4.5%, that becomes very important for us. So let's just make sure that we keep a close eye on that. Now, I mentioned oil off the jump today. Let's look at oil as an understanding of why we got a little bit of pressure this morning. So we're going to look at the futures, crude light futures /CL here. And again, we're not validating or encouraging futures trading. We're watching oil so that we understand the potential movements as it relates to the broader markets. So we see that oil has found support down here at around 87 or so last week with the lows. Let's zoom in here. We have a potential hold move today. So if this pullback is considered Friday's low is considered the low in our drawdown, well then having traded through it today could tell us that we've got more of a rally. Now, the good news is because we have broken this triangle and broken what was the uptrend line, can now act as resistance. Now that doesn't mean it has to, right? But a rally into this could be an area at which the rally ceases. If it gets back above both the 20, the 50, the trend line, all of that, that would be a wonderful heads up to the pressure we're feeling. So know that a rally into that level, approximately 97.5, 98 bucks a barrel, that could be resistance. It doesn't mean it has to be, but the importance of that level cannot be overstated. If we get to 98, we get rejected, bulls remain in charge, equity markets are likely to continue their bullishness. If we get back above it and 98 holds for any extended period, the risk becomes higher oil once more, and thus inflationary issues and probably some headwinds on the market as well. Okay, so this is very important discussion for what could play out over the coming week. Obviously, headlines will play a part in all of this. So pay close attention, utilize oil, utilize yields as a way of kind of understanding the thought process of traders right now. With pressures in oil, higher yields, the market takes its breathers. It's the movements around all of that that can help us understand our trends. Okay, so that's what you've got on the broad look at things. S&P, NASDAQ, Russell, yield, and oil. Let's check out what's happening with our semis today. They're up 0.5% here. So no chill. It basically is what we're seeing, right, everybody? No chill on the semiconductors. The trend continues. We've got a little bit of a flag up here. Risk factors, all the same. But if you are watching the semis, you want to see us maintain our gap, right? So how do we manage risk along the way? we look at the levels where we would lose comfort or our comfort would change. We would get maybe a little bit more defensive under the gap zone, right? So some traders, if you've put on positions way back here and you're staring at what are probably something like, oh, I don't know, was that 80%? Yeah, 80% profits. You want to protect as much of that as possible. You also want to let it run if it's going to keep running. So what do we look at? First layer, possibly the gap zone. Second layer, former highs, potential support. But you know what? Again, all of these levels are so close to each other. This is at 12,100. This one is 12,400. That's a very small move relative to the size of the index here. And the level that seems to be most important in all of this has likely got to be that 20-day, doesn't it? Look at the last time we tested it. It was an explosive move immediately. I mean, we got, even if you bought it at the high this day on the bounce to where we are, you're up 11.75%. So if you're trading just based on tests of support, make sure that you lean into the fact that you're trading it, right? Not that I'm buying this to own it for the next weeks, months, years, but rather I bought it because I think I could sell it higher down the road, and my goal was 10%, 12%, 20%, whatever. Lean into why you bought it in the first place. If you bought it for a trade and it moves in your favor, look at ways to protect those profits. And one of those ways is choosing to be a seller on weakness like this. Picking, as Rita points out, when they're this close, picking support is kind of tough, right? So picking the right level of support might not be the important thing, but rather leaning into your management of your profits. And you look at those profits and you say, should I be taking risk off? Should I be sticking with the trade? Some traders will just start to sell a little bit. And by selling just a little bit, what you end up finding is that you could stay with the remaining portion of your trade for longer. On the legs of our stool here, so we're going to hit up the big three. We'll hit up airlines. All right, airlines pulling back. We've entered the gap. So this could act as short-run support, right? We've basically filled this gap. If this gap level doesn't hold, then we've got opportunity to consider the next level of gap. Now, that's a big one here, right? So keeping an eye on airlines and the movement in oil, absolutely oil impacting airfare. And airlines in general. Now let's look at our truckers. We know that oil is expensive, and as it relates to diesel, even more expensive, but truckers are holding up pretty darn well, down 1% here. Bull flagging a little bit at these upper levels. We do have a bit of a divergence though, so maybe we make note of the fact that we've got a bearish divergence. It could mean a longer consolidation. It could mean a need for a support test, but it does, remember, divergences, what they tell us is that this trend is not as strong as it may be thought to be, but it does not imply, or rather we should not infer from that move that it is a reversal imminent. Okay, there's a big difference in a reversal versus a pause, and a divergence like this could simply be a pause. So let's just keep that in mind as well. Okay, there's our truckers. Let's look at our rail stocks. All right, now rail stocks have pulled back to the channel line. This is an interesting spot, everybody, on the rails. Let me lift some of these details just so you can see it. If I back this out, look, we were in this beautiful channel for a long while, and then we broke the channel to the upside. Remember, what once was resistance can become support. Often we get to a spot of over analyzing our process a little bit. This was a channel trend, worked beautifully. Now what have we done? We've rallied, we rallied to new highs and pulled back to the channel line, but we've also, why don't I just take this line out here, because this was prior highs, but look what else we've done. We came right to the level of the gap, or almost to the level of the gap, right? So this is an area of excellent support, validated simply by the gap level here, the rising 50-day moving average, and the former resistance on the channel could easily act as support. Doesn't mean it will, but you can tell a story about why it could act as support right here, right? So rail stocks at an area of short run support potentially. Let's see if that holds up on them. Okay, what about some sector action here, everybody? Let's take a look at what's moving around. Obviously, we're going to take a look at energy because you're getting a little bit of a bounce there today with good reason. So let's take a peek there at energy. Right at the bottom of the channel, this is a new channel. They fell outside of it on Friday and getting right back into it. Obviously, very much tied to what's happening with oil. So let's make sure that if we are going to remain in the channel, well, then we have the opportunity to trade to the upper level. But of course, first thing you got to do, we got to get through the moving averages. Now, the truth is, as we've consolidated over the last few months here, last 2 months plus, you'll notice that the moving averages are right on top of us and they do not, and they're meandering through things. We're not exactly seeing consistency of resistance or support here. But if we went with something a little different, how about the 100-day moving average? Well, now we seem to find the area that may matter. Now, it doesn't mean that's going to hold, right? But it certainly looks like this could be support for us. The other thing that I have to note, you have a matching RSI move, right? So RSI's lows match up with our lows against the channel and our recent price action. If nothing else, everybody, if you've been watching energy, this you can certainly maybe at this point consider the 100-day moving average enough support that you would say, boy, under the low we made on Friday, you might feel less bullish, right? At least as it relates to energy broadly. And so on a close under Friday's low, some traders would take some off, just as an example of management, trade management, so forth, right? Doesn't mean it has to do that. This certainly looking like we're trying to get a bounce here today. Obviously, the bounce that we are getting largely tied to the move in oil, and today's price action on oil will dictate whether we get today and the rest of the week, whether we get continuation here. Obviously, again, headline risk. Let's pay attention as much as we can. Let's see, moving on through, we got materials selling down a little bit. Let's back our charts back off. Let's go with a more standard 200-day moving average. So you can see we've been under some consolidation here, having not made any new highs recently. So materials pulling back. We've got industrials holding an important level. I think this is the 50-day moving average on industrials, sure enough. So you've got horizontal support. I'll tell you what, everybody, there's one key takeaway here on industrials, and I think it's the level of support. We'd love it to be the 50-day, but you can see the importance of support here. And again, the reminder isn't that we know definitively, positively, oh, this is going to hold as support, or no, this won't hold as support. We don't know, but we know it's a significant level because we've tested it multiple times. It was a gap level, etc., right? So what does that tell us? It tells us that if we traded under it, well, then we must take heed. So if you're investing in industrial positions, industrial stocks, and you witness the industrial sector break down through that area of short-term support, it would be a bad development for the industrials and individual equities within that space. Just know that, okay? Additionally, if it came down and bounced off of that, that would be a further validation of this area as support, and it would further suggest traders would only lighten up on moves under it, right? As long as that level's maintained, traders are apt to be remaining constructive or optimistic as it relates to industrials. So that's a fairly important spot. Now let's keep on moving here. We're seeing discretionary take a little breather today off 1 3/4%. Let's see how this one appears in the charts. Had a good move to resistance here, basically. These are all-time levels. This white line up here, all-time highs in the discretionary space, so we would like to move through it, but we are pulling back a little here at this point. Not that that's it's not a terrible development, obviously, but we don't want to see a deeper pullback than that. Certainly not deeper than the 50-day, because the 50-day lines up so beautifully at the moment with what we've got going on here. So here's our 50-day, and our horizontal support happens to be similar to it, right? So some confluence there. That's an important level for us. Now, if we get a hold up above it, so let's say we bounce at the 20-day, then traders are going to be here a little bit more optimistic about the ability to break through there a little more speedily. So we'll monitor that. Now, Staples last week broke down. And of course, this was, again, if you think about it from the relationship aspect here, the relationship of staples versus your technology, for example. Staples, as we know, more defensive in nature. We're going to see that when money is moving into technology, the enthusiasm, the optimism, the bullishness, etc., where are they going to pull from? They're going to pull from those areas that have been defensive. Well, staples got pulled from quite heavily over the last 2 weeks. In fact, if you look at the peak to the bottom we made intraday today, about almost an 8% pullback over the course of 2 weeks. So this, again, a very important level of short-run support. Let's put up our major moving averages. How about that? The 200-day resides right there. Now, does that mean you have to go run out and buy your staples positions? Not necessarily, but it is notable that the bounce off of this area, this could very well be a spot where traders are looking to staples positions for opportunity. Now, we'll look at a couple of stocks in that area, perhaps. They're being either in the news or otherwise, but I just think this is a good reminder of that relationship move, right? When we have risk on, we see money flowing into discretionaries, into technology, and so forth. And when we get the breathers in those, we see money flowing into your defensive, your staples, maybe some finance, maybe some healthcare. So things to bear in mind is the relationship between these sectors and the way money flows one way or the other. Let's look at that healthcare. All right, so healthcare here. We got pushed back from resistance. Now we're at the 200-day, so we're pretty much at the midpoint of this range that we've seen since mid-March. So we're looking at about about a 10-week range here, right? And we rallied into it, have pulled back. Now we're testing the 200 here. We're right at the 200 as we speak. Could see some improvement there, but we're at an area that could be supportive. Now, with as much as we want to believe in the 200-day, I got to look at the confluence of the 20 and the 50 down below. And again, I would say, if you're looking at this one, you're thinking, all right, what's the difference between setting support at 1710, let's say, versus, the last low we made here at 1665, or even down at the extended low 1655. It's all about doing that math. If it's if I'm going to move on under 1655, but I'm sticking with it at 1705, it means I'm comfortable enough to have 50 points of downside risk to be proven that I was wrong. And then will I be a seller, right? And if you said, well, I'm not going to stick with the entirety of my position to watch it fall 50 points and then tell me that it's going to break down further. So if you're uncomfortable with the potential for a 50-point move lower in the space like this, well, then you want to be light enough in your size of positions to handle that type of a pullback, right? That's where management of position size becomes so important. That's why we talk about it so much here in Trader Talk. All right, next up, financials. I've been talking about financials because I think it's improving here. I'll show you what I'm talking about. Let me clear out this rectangle. It's all about the 50-day, everyone. Broken downtrend. Since the break of the downtrend, a gap higher into and through the 50-day moving average that has now provided support once, twice, three-ish. Maybe I just extend this out a little bit, 3 times, right? You could certainly utilize, I'm sure there are many a trader out here who are going to use the 50-day moving average as support in financials. A nice couple of key things that traders are going to talk about are the fact that we've held it, as is the fact that we've got this lovely upsloping curvature to the 50-day moving average now, providing more support. Alternatively, you've got a couple of things for consideration. I think, again, the 50-day, this last low, but if you're looking at it as such, why not just go to the lowest low we've had and use this, right? Because under this, we've got gap zone risk, and then gap risk is the kind of thing that can lead to bigger selling, right? So that's one of the reasons you might monitor that. All right, so financials still holding in pretty well. We'll see how that if that changes here. What about our Okay, communications. Oh, I'm skipped on tech here. We'll come back to tech in just a second, everybody. We fell through the 20-day. We've been below it for about 3 sessions, it looks like. Let's see. If we count, well, I guess we got to count those last two. Thursday, Friday, we're above the 20-day, but now we are trading at our lowest we have traded since the gap move higher. So that could be noted as a significant development. Where could horizontal support be? Perhaps at the prior highs. Maybe it's the 50-day moving average, so that's worth monitoring here in communications. Let's jump back to tech for y'all. I mean, not much more to say about technology, right? Other than the reminder that we can stay in what are considered to be overbought conditions for longer than we expect. Try not to use overbought as a validation of a reason for selling. We don't need to do that, okay? So I like to at least remind you of that, when we're thinking about the overbought nature of a position, an index, what have you, we can stay overbought for a lot longer. And even a pullback that resulted in a drawdown to the 10-day moving average, for example, there's no guarantee that that's going to result in a breakdown of the trend, right? And you could pull back to the 10-day and see the RSI holding into overbought conditions every step of the way. So there's no guarantee that that's even going to play out that way. All right, so make sure that you're giving thought to these things. Obviously, overbought conditions give traders a little bit of discomfort, but it does not mean that you can't stay the course. Make sure you're trading to your own comfort, maintaining positions the way that you are most comfortable, and don't be averse to selling if it's going to give you comfort. Yeah, we know that what you hear here in this class frequently is that we're working to maintain positions as long as we can, right? We talk about that frequently as traders. If we have a winner, we want it to stay a winner, so we want to hold it for as long as we possibly can. But by no means does that mean that we need to be sticking with something that's not working or something that's giving you a discomfort, right? And like I said, largely that'll fall into your risk tolerance conversation more than anything else. It'll be largely tied to the size of your position more so, and it probably means if you're uncomfortable that you do need to take some semblance of market action. But understanding that and balancing it against the current trend can help to put you in the proper position size along the way. So you're going to be learning about this here constantly. It's not likely that you'll be not experiencing some growing pains. Okay, so my encouragement is to find out what is that amount of dollar invested to an individual position that allows you the ability to stay with it for as long as possible, right? And I think that that's a really big aspect of trading is understanding true risk. It varies quite a bit from all of us traders individually. Okay, last two groups to check on here. We've got utilities selling down a little bit. So this pullback to an area that could be support. Again, we might be kind of grasping at straws here in utilities. Taking a look here, there is some horizontal support in this range, but by no means does that have to hold up. So we'll see. Now, utilities falling a little bit, yields rising a little bit. This is probably the same reason you're seeing REITs take a little bit of a breather, but remember, if yields are rising, then what we're seeing is traders having more comfort with that so-called risk-free rate of return, right? You lean into the 10-year Treasury note at 4.5%. But if yields are falling and dropping, what you get is a willingness of traders to expose more money to these equity positions that offer both growth upside with interest and or dividends. So this is a notable area of the market as well, and we're seeing it breathe as yields are rallying a little bit. Let us see about real estate. Reminder that here these are REITs. These are not your discretionary selling of homes. We'll look at home builders momentarily, but REITs These carry a far different level of risk. Remember, these are frequently dividend payers, but no dividend is guaranteed to be paid. So depending on how you choose to evaluate this, the trend's notable. It is a little bit range bound in here over the last couple of months, right? We can see that. But just know that there are different risk factors associated with REITs, and understand the relationship again with yields moving upward. You're going to see pressure on those sectors that generally are benefiting from lower yields in this case, and yields moving up, putting a little bit of pressure here. I did mention home builders. Let's take a look at just the broad home builder space. I'm going to use my Dow Jones symbols in here. Home builders been under pressure. We've fell through the 200-day. Boy, this is yet again another example of what once was support can become resistance. 200-day support rally, breakdown, fell through the 200-day, and then rallied back into the 200-day, found that to be resistance, and now we've made a lower low. Now, we did make a lower low with a divergence. So we've had a divergent lower low. Okay, so if we would say, if nothing else, it's a relative higher low in some regard, right? So could we see home builders push into the 200-day once more? It's certainly possible. First thing you got to do is you got to make a new short-term high, and that's going to be through this level approximately right here, basically the high we achieved on Friday. And you're probably potentially looking at an opportunity to rally into the 200-day moving average. But again, that is still below the 200, and so a lot of traders just kind of say hands off from a trend trade standpoint if your position or the index or what have you is below the 200-day moving average. All right, gang, I've got a couple of individual equities for you here today for notes and details. So we've had a couple of upgrades, a couple of downgrades. Let's talk about them. First one on the upgrade list, Zscaler, ZS. Now, Zscaler has been in a bit of a struggle. We've been pushed back pretty aggressively. Let's see here. We peaked in October, and then we bottomed out here back in April. That's a sell-off of about 66%, less than ideal. We zoom back into what's gone on lately. We've made a double bottom almost. Well, I guess we didn't quite get down there, did we? Nope. So we have support here at the last low. We've made a slightly higher low. Friday, we got a hold, a close above the high of the low day, with Friday being our low day. Today, you're getting a little bit of a follow through. Now, the news here was Guggenheim upgrading Zscaler to buy from neutral. They put a target on them at 214. They are admitting this is a trust me story. They state that what I guess that means is trust Guggenheim in this instance, but they state that the valuation here presents an opportunity to buy a category leader of a still nascent and hyper-growth market, according to the analyst's note for investors. Their relevance is likely to grow in the area of AI, is the further comment made here. So again, a target at 214, that represents a heck of a premium to where we are right now. But remember, that's just a target from the analyst. That's by no means any guarantee to be achieved, of course. So if it were, I mean, that's a wonderful development. But 214 does still put you below the 200-day moving average. That seems notable as well. So anything you might be doing here, just remember, could easily be considered to be counter trend trade. So keep that in mind on Zscaler. But an analyst upgrading a stock near lows, at least if nothing else, I can say that I like an analyst is willing to put their neck on the line here a little bit, right? Because you've got a stock that's already in a downtrend. That's better than seeing the stock rally 30, 40, 50% and then getting the upgrade, which always makes me a little crazy. Now, we had a big week last week in Dell. As you can see, some continuation. How about another 8% upside move? So Dell was upgraded at Morgan Stanley to equal weight from underweight. Their new target, get this, 448. We're already through it. But the prior target was 170, everybody. According to the Morgan Stanley analyst, company's Q1 earnings report visit to Taiwan last week indicate that Dell is managing the current semiconductor supply chain shortage better than their peers. Morgan Stanley cites the alleviated memory concerns for their upgrade today. They believe Dell is, quote, executing across nearly all business lines with while taking market share of a growing AI spending pie. So we've got a lot of spending. Dell is taking advantage of it. Big move to the upside. Manage your risk, of course, everybody, once more. A lot of traders are going to look at the level of the gap. And in many of these cases, when you get a gap so significant, traders are going to be looking at that as acting as massive support, right? So many a trader will look at this and say, boy, if it got back down under that low we just made on Friday, I need to take some profits. And of course, many of you will say, Kevin, that's 50 points away. Why would I wait that long? And some of you might not, right? So it may very well take a trader to say, here's what I'm going to do. I'm going to go ahead and sell 10%, 25% as it's running and protect a good chunk of my profits, and then I'll put a stop order down below it. Now remember, a stop order doesn't guarantee any price, of course, but it does give you the way to manage your own risk. And it doesn't have to be a traditional plain vanilla stop that triggers and becomes a market order. Some traders might choose now to utilize a trailing stop. That's another order type that links your stop to the highest high the stock makes once you have set your stop order. That could also be a good way to give consideration to that for any order type. So if you're looking for some assistance on that, the trailing stop is an order type that we have covered before. I have covered it recently in building a stock portfolio class over the last 2 or 3 weeks. If you wanted to take a look at that class, I host that one on Tuesday afternoons, but we have incorporated a couple of trailing stop orders there recently, and if you looked at the last couple of weeks' classes, you'd find some discussion on those. All right, one more upgrade opportunity, and it's on Kohl's, KSS. Now, Kohl's has been, as my friend Barb likes to say, on the struggle bus as well. We're below the 200-day moving average. We did have a divergence again. So we have a lower low in price, higher low RSI. So again, remember, we know that that's not necessarily, we can't infer that that means that it has to go higher. But there are some developments that are notable here beyond the upgrade. They got upgraded, by the way, at Citi to buy from neutral. The target is $22. That's up from $14. That does, again, represent a nice premium relative to current price, but no guarantee we get there. The firm cites valuation for the upgrade. The market is too bearish on the company's free cash flow, and Citi sees a favorable risk reward at these current levels. The market has a, quote, misguided view, end quote, of Kohl's debt, according to Citi. Now, the biggest thing from a technical standpoint probably is right here, the broken downtrend. And if nothing else, traders could easily rely on maybe the last low we just made with Friday's move, but you haven't gotten a hold or even a trade above the high of the low day here. If this is the only pullback, it's tough to suggest that that's the way it's going to play out, but a broken downtrend is commonly that first signal that leads traders into a new position. If nothing else, it bears watching. You might find this as a good add to a watch list, given the recent break, given the upgrade, etc. Now, one of the things that I have added to these classes that are ones where I'm hosting solo for you is to bring in a little bit of individual equity trade discussion. And last Thursday, we had a solo class and we placed an order on Synopsys. So let's just take a quick peek at how that one's doing. It looks like it's relatively flat. We have a small position. It's not big for us, only 10 shares. But the reason we set it up that way was because we wanted to manage and monitor it properly. So you have a stock that has met resistance at that 535 level. It is above the 200-day moving average. It is testing the 200-day moving average as we speak. Now, we placed a stop order on this for protection as a means of reducing our risk, and we did so based on an average true range below the 200-day moving average. So our 200-day comes in at 468, and our existing stop is in here at 442. So we're giving this a bit of wiggle room, to say the least, but it encourages us to do that because it gives us the ability to maybe stick with the position through some machinations, right? If the 200-day holds up and we get a bounce from here, then we can possibly consider raising this stop. If we can take out 535, that's going to likely be our best instance where we have a chance to elevate the stop and try and work to maintain any new profits we have associated with the position. So with that, everybody, we are at time. Now, coming up here soon, this weekend, we're out in San Diego for our next technical analysis and options workshop. So come visit if you have not been able to attend. We'd love to see you for those events. Remember, you can find everything for us in person, schwab.com/coaching, and our live events calendar or our in-person events calendar resides right there for you. So make sure you're following Brent and me on X, Brent Moore CS, Kevin Horner CS. If you like this discussion today, the kickoff for the first week of June and the first day of the month, hit that thumbs up button for me down below. Of course, we get this reviewed into the archive as quickly as we can, and would love to have that thumbs up. It helps us out quite a bit on the replay of the show. But have no fear, there's more to come from us the remainder of the day here. Of course, we will be back at 11 a.m. Eastern with a very new class, everybody. My friend Ben Watson, joined by Jim Ferrioli, is going to be discussing cryptocurrency basics. This is a brand new class, take you through the basic underlying detail associated with crypto. It's going to be a wonderful opportunity to learn more about this important space in the market. So with that, have a great rest of your Monday, everybody. I look forward to catching up with you again real soon.